this video, we're going to talk about NIO, trading under the ticker symbol NIO. We're going to cover the price action over the past few days, the company itself, and the recommendations regarding buying, holding, or selling the shares. If you would like to see more stock analysis videos, please like, comment, and subscribe to my channel. But before today's video begins, I'd just like to clarify a few things about the timing when my videos are recorded, uploaded, and how much they react to the latest market updates. Those are prepared, recorded on the day before, and scheduled for the next day. If there are significant and volatile movements during the trading day, they will not be reflected in the video itself. With that being said, to the extent possible, my analysis will be based on the medium term, or even the long term, and not necessarily on the intraday movements. The main reason why it shouldn't matter that much is because most people investing in stocks, or even just trading in and out of their positions, usually keep their positions open for at least a few weeks. With that being said, if there are significant movements in the stock price that happens afterwards, either they will not affect the overall picture, so in that case we will cover them the next time we're supposed to cover them, or if they are significant enough that they change the outlooks, then yes, I will do a follow-up video in the shortest delay possible with a reevaluation of what I think should happen next. NIO is a Chinese EV manufacturer operating mostly in Asia and now considering to expand in other markets as well. The main appeal of NIO is that for a fairly long period of time, its stock price managed to mimic the stock price of Tesla way back in 2020, and that many in the industry view NIO as a potential rival or viable alternative to Tesla, as one of the most valuable companies in the world, if investors wish to participate in this very promising sector. Another appeal of the company is that it is operating out of one of the most valuable markets, the one with most future potentials as far as EV sales are concerned. But of course, with those upsides also come the risks. NIO is traded in the US but doesn't have the bulk of its operations within the SEC's regulations, which may consist of risks regarding whether the books are fair and reflecting the reality. Some of you may remember the example of Luckin Coffee. So basically, the books were not reflecting the reality, and as a result, it got delisted, causing huge losses to investors. The market cap of NIO is currently at $48.5 billion, and the enterprise value is at $52.1 billion. The market cap is the price tag financial market is willing to evaluate NIO stock at, with consideration to its future potentials and short-term fundamentals. The enterprise value of the company is the net result of the company's assets once all the debts are paid back. Usually, the market cap is higher than the EV, but sometimes there are exceptions. In this case, it is the case for NIO, because NIO's market cap is actually lower than the enterprise value. So there are two explanations. Number one, it could be because NIO's assets are consisting of a lot of goodwill. So this is one possibility. And number two, maybe the market isn't really willing to put that much valuation in NIO at the moment, or the sector at large at the moment. The quick ratio of NIO is 1.98. The current ratio is 2.04, and the debt over equity is 0.69. The average trading volume of NIO has been 48.5 million shares, and the daily volumes have been 36.7 million shares, 28.7 million shares, and 36.1 million shares. The one-year beta of NIO has been so far 2.27, which is very volatile for the market. Its 52-week high is $66.99, and a 52-week low is $27.52. Now, let's also talk about the options market for NIO. In terms of volume and open interest, the options market seems to favor the call side, but with significant demand for put options as well. Generally speaking, the put options mean that the market expects a correction or pullback, and the calls options mean that the market expects the prices to move up. The key strike prices where there seems to be the most interest are $28, $29, and $30. Regarding NEO, I think that what comes down to it is that it is representative of the great run many EV believers had back in 2020, and that many tried to recreate in 2021 with some degree of success. As this current year is drawing nearly to its end, I believe that we need to look at the company with new perspectives. On one hand, NEO is still having excellent fundamental results. Considering to expand overseas in both Europe and North America, the job postings recently released by the company are heavily suggesting that NEO will be expanding in North America in 2022. In other words, as far as the company is concerned, fundamentally, things are going well. On the flip side of the coin, I think that a very significant factor of the stock performance of NEO will depend on the overall market sentiment and the mood investors have towards EV sector at large. Some of the price movements we see with NEO is caused by the general sloppiness of the sector, especially considering that many of them are valued as multi-billion-dollar enterprises and that their sales are about a fraction of what traditional manufacturers manage to sell. It didn't stop them from getting those amazing valuations back then, and in a way, the market is pricing in this as a fact. It doesn't mean, however, that the market will always be comfortable with those valuations. And something else to consider is that if we think of those companies as tech companies, then yeah, sure, those valuations are more than reasonable, or at least within the bounds of what's reasonable. But if we look at those companies as car manufacturing companies, then we do need to maybe look at the valuations more thoroughly. Especially recently, the NEO stock was under pressure because Ford began selling their EV cars in China. So if Ford is a competitor, what does it say about the nature of the business that NEO is in, right? Is it a car company or is it a tech company? So this is just some food for thought. Another thing that we gotta consider is that the sector is getting more crowded as we move forward, because existing companies are now competing by rolling out new models, and there are still new companies joining the sector. Some of them that come to my mind are Polestar and potentially FFIE. Now, many say that this is just a scam, but we never know what's gonna happen with a company like this. Maybe one day they're gonna start rolling out new models, so we cannot roll this out just yet. This is without mentioning that other companies like Fisker will be eventually rolling out their models as well, so the market may also decide to put their eggs in more basket instead of just putting them in a few monoliths. One final factor to consider is the actual health of global economies. There have been red flags over the years, but recently, quite a few of those indicators became real-life facts regarding the potential negative growth the world may see in the years to come, both in Asia and outside of it. All those elements do suggest that 2022 may be an interesting year as far as volatility is concerned. My recommendation is to keep the overall tendency bullish about NEO, but to always keep in mind that those factors that we mentioned do exist and that we should control our maximum exposure and to minimize the entry point. I would suggest to maintain a maximum exposure in NEO up to 5% of your portfolio and to enter in the trade only if there are more support found. Right now, the correction is still underway, which is why I would prefer to wait for another few trading sessions at least to see if the market is more willing to get in. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks being shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.